Advanced Financial Modeling, Topic 11, Cost of Capital and Real Options, Learning Objective number 2. We're going to estimate the cost of equity using CAPM. So while historical returns on stocks, while historical returns on stocks are observable, there is no observable or stated future rate of return for equity or stocks. Unlike bonds that have a stated interest rate or loans that have a stated interest rate, stocks do not have a stated rate of return. So we need a model to estimate the rate of return of a stock. The standard model for estimating that is called CAPM, the Capital Asset Pricing Model, and we're going to walk you through that model right now. So this model or theory of CAPM starts with an assumption. That assumption is that the average investor is rationally diversified into many stocks. No one's dumb enough to hold just one stock. Therefore, if you're looking at the required return or the CAPM return of any individual stocks, it depends on the risk of that stock relative to an overall diversified portfolio of stocks, and we'll call that the market portfolio. This measure of risk of a stock compared to the overall market is called beta in the CAPM model, which is the regression coefficient or slope when you regress the stock's returns against the market's returns. And the S&P 500 is usually used as a proxy for the market. So for example, for Walmart, over a 5-year period, and if we were to regress the returns of Walmart against the S&P 500 on this XY scattergram, where each one of these dots represents a return on Walmart and a return on the S&P 500 for a particular month. And for example, say this point here, Walmart's return would be this level here, and this level here would be the S&P 500's return. So if we graphed all this data and then tried to fit a best fit line through it, the slope of that best fit line is beta, and it's a measure of the risk of the stock. Is the market risk of the stock. So what's the interpretation? If the slope of that line is equal to 1, what that means that when the market tends to be up 10%, the stock tends to be up 10%. Market's down 10, stock's down 10. So we say it has that stock has the same market risk as same risk as the market. If that beta is greater than 1, has a higher slope, that means when, say, the market's up 10, that stock's up 15. Down 10, down 15. So it's riskier than the market. And if that slope were less than 1, a little bit flat there, what we'd say is when the market's up 10, that stock is maybe only up 0.5. That would be a slope of 0.5 or a beta of 0.5. So how do we actually calculate this beta? Well, I have some data set here of Walmart's returns. And you can see here's S&P 500 prices and Walmart prices. Are actually adjusted prices, which include dividends, so we can get total return. So this data here is the returns of the S&P 500, the returns of Walmart over this 5-year period. I can just do a slope function in Excel where I put in the stock returns, comma, the S&P 500 returns, and I get 0.344. If I wanted to get the R squared of that regression, I would do RSQ, put Walmart's returns. I'm doing Control-Shift-Enter to get the whole series, comma, S&P 500, Control-Shift-Enter, and I got the R squared. So I got a slope of 0.34, that's my beta, and an R squared of 0.05. Now, why is that R squared so low? Well, look at the data. If all those data points were really hugging this line, you get an R squared closer to 1. 100% of the variance in Walmart's returns are explained by the S&P 500. But when it looks like this buckshot returns, and the line just fits through there, it's saying that the beta or the S&P 500 is not explaining a large variance or a large proportion of the variance of Walmart. So that's going to be a concern later we'll talk about. All right, now why would a stock have a low or high beta? Well, let's think about Walmart. Walmart is actually a firm with very little debt, and it tends to sell discount goods and foods. So companies that sell discount goods and foods when the market goes up and down, people aren't buying more or less food in general, and more or less discount food. So you'd think they'd have a low beta because as the market goes up and down, it's not influencing the total returns of Walmart. On the other hand, Walmart has very little debt. So when the market is booming or down, it's not going to have a big effect on Walmart. Firms that have lots of debt and the market goes down, they go down even further because they have these fixed costs for their capital and they have to keep paying them. So they might have an even worse quarter when the market's down. All right, so this makes sense that Walmart has a low beta. They have low debt and they tend to sell non-luxury goods. So here's the CAPM formula. The CAPM formula says that the return of any risky asset, we'll call it KE, so this is the expected return of say, Walmart, is the risk-free rate. I'm going to use the 10-year Treasury as the risk-free rate as a proxy for the risk-free rate of return, plus the beta times the return on the market minus the risk-free rate. Now let's look at the big picture. The big picture is CAPM says every risky asset has to at least give you the risk-free rate of return plus a compensation for risk. So you can think of the CAPM formula as every risky asset gives you the risk-free rate of return plus a compensation for risk. The compensation for risk is that second term. Before we move on to the compensation for risk, sometimes CAPM, some people use T-bills here, 1-year treasuries or shorter, and some people use long-term treasuries, say 10-year treasuries. I tend to use 10-year treasuries. I'm following Aswath Damodaran's NYU guidance that most people that are considering stock investments are looking for long-term investments. So a proxy for a long-term risk-free investment may be a treasury, not a T-bill. All right, so risk-free rate, I'm going to use the 10-year treasury yield. Now, the compensation for risk, it's going to be the amount of risk or the measure of risk, beta, times the compensation per unit of risk. So it's my amount of risk, beta, times the compensation per unit of risk. This was called it's called the market risk premium, which is the difference between the expected return on the total market minus that risk-free rate from over here. So this is the CAPM formula. Now let's talk about these terms a little bit. How would I get these terms? Well, beta, we can use a regression. We just did that. Risk-free rate, we can use 10-year treasuries. Now, this is the expected return of the market, so I can get a forecast of the expected return of the S&P 500. And again, this is the 10-year treasury rate. However, we often think about this as not as these two separate terms, expected return of the market minus RF. We think about the difference, the market risk premium. It's the expected return of the market above treasuries. The expected return of the market above treasuries. And hopefully it's a forward-looking measure, not just backward-looking. But unfortunately, we just have a lot of data looking backwards, and we hope the future looks like the past. So here's how we're going to try to estimate the market risk premium. I have a data set here. If you go to Excel and go to market data, I have the return of large cap stocks, say the S&P 500, and the return of long-term treasury bonds, the 10-year treasury, and from 1926 to 2015. If you take an average of the returns of the large cap stocks minus the returns on treasuries from 1926 to 2015, it's about 6%, 6.16%, with a standard deviation of 21.78. So, if you just have 100 years of data almost here, I'm going to use maybe 6%. So that's one place to look for it. If you actually use the short-term treasuries as a measure of risk-free rate, that's averaged about 8%. So what I'm going to probably use here is a number maybe close to 6%. In practice, people that are estimating rates of returns for CAPM often use a rate between, say, 4 and 8. For now, let's go ahead and use 6.16 since that's the almost 100-year average. So here's my formula for the CAPM rate of return for Walmart. At the time of this valuation, 10-year treasuries were 1.95. I estimated the beta to be 0.344, and I estimate the expected return of the market over treasuries to be 6.16. Therefore, I should demand 4.06 return for Walmart stock. I'm going to demand at least 1.95 because a risky stock has to at least give me the return of the Walmart return has to at least give me the return of a risk-free asset, and the compensation for risk, well, that's the other 2%, and that gives me 4.06. Now I wanted to talk a little bit about beta and leverage. So let's just do a what if analysis, then we'll use that in a minute. What would Walmart's beta be if it had no debt or twice its debt or twice its DDE ratio? So unlevered, when we talk about what would the beta be if it had no debt, we're going to use the concept of unlevered beta. What would Walmart's beta be if it had no debt? Well, we're going to use a formula that an unlevered beta, a theoretical beta if a firm had no debt, would be their levered beta, say the one we just calculated, we'll just round that up to 0.35, divided by 1 plus their DDE ratio, where I'm going to use net debt over total market value of equity. So for Walmart, if I take their beta of 0.35, that's their levered beta or equity beta, and I divide by 1 plus their DDE ratio, they had net debt of 66 billion and equity of 340 billion, I would have a beta of 0.293. So that makes sense. Their beta would be lower if they had no debt, because if they had no debt, when times are bad, they're not going to be hurt as much because they don't have those fixed cost in production. Fixed cost in financing. And now let's use that unlevered beta to do our second what if analysis. What would the beta of Walmart be if they had twice their current DDE ratio? Well, I can use this formula, which is just rearranging the formula from above. A levered beta is an unlevered beta times 1 plus the times 1 plus the DDE ratio. So if I take Walmart's unlevered beta of 0.93 and I just say it's 1 plus 2 times their DDE ratio. So I'll just put in a 2 here, 2 times their DDE ratio. Walmart would have a beta of 0.4067 if they doubled their DDE ratio from this 66 over 340 to twice that level. All right, so you could use this concept to make what if analysis, that if you're looking for a company, if you're trying to estimate the cost of equity for a company that's changing its financial leverage, changing its DDE ratio, you can use these formulas to adjust their betas. And we're also going to use it in this other concept of an industry beta. So we saw when we calculated beta, we didn't talk much about it, but this R squared is terrible, 0.05%. So 5% of Walmart's variation in Walmart's returns are explained by the market. So 95% is explained by other things. So I use that to calculate the beta, but I'm very nervous about calculating that beta. And also those betas are notoriously fickle. If I measure them, say, different periods of time, they change quite a bit. An alternative to using this regression beta is to use an industry beta that tends to be more stable. Now, industry betas are available at this link below from Aswat Damodaran at NYU and New York University. And what it looks like is, I'll go to the spreadsheet. It looks like this, his data set. And what you have is different industries and their unlevered betas. So how would I calculate that? Well, we can do the calculation I just did before, unlevering the beta. But if I'm doing it for, say, grocery stores, I can do it for a collection of, say, 5 or 10 grocery stores and take a weighted average of their unlevered betas. And that's what this data here is representing. So how could I estimate a beta using industry betas for Walmart? Well, Walmart's a little bit interesting in that Walmart is not just a goods store, and it's a goods, a discount retailer, but it's also a grocery store. So at the time I looked, Walmart gets about half their revenues from groceries and half their revenues from general retail. So the unlevered industry beta for grocery, when I looked this up, was 0.28. The unlevered beta for general retail from Aswat Damodaran's website for industry beta was 0.75. So I take Walmart, it's half a grocery store and half a general retail store. So you can say that if I use the industry unlevered beta, I would get 0.5150. So that in theory would be the beta of a company that's half groceries and half general retail that has zero debt, unlevered. But we know Walmart doesn't have zero debt. They have $66 billion of debt and $340 billion of equity. So what I'll do is I'll take my formula, unlevered beta times 1 plus the DD ratio, and lever Walmart's theoretical industry beta, unlevered industry beta, by Walmart's DD ratio. And I say, well, Walmart in theory should have a 0.615 beta given their debt levels and given what industries they're in. So I can use that beta, that levered industry beta, in my CAPM formula, risk-free rate plus that new beta times my market risk premium, which I'll just say is 6%. And now I have a 5.64% beta, CAPM cost of equity for Walmart. Now, in general, industry betas are preferred estimates for firms with unstable betas, which I have found for Walmart, and or unstable leverage. They're changing their leverage up and down. And it's also used for private firms. So if I wanted to estimate the expected required return of a local grocery store that doesn't have a stock, I would use this method. All right, so in this topic, we estimated the cost of capital using CAPM, and we used Walmart as an example.